think that would allow us a lot of flexibility and a lot more strategic planning as we come into our lower sales seasons. If we're thinking Q1, maybe I can punt my payables down 60 days and make sure that the development of my restaurant continues and we're able to keep growing. You have 5 units and you have an entire walk-in go down. Again, is that buffer and that safety net to say, we don't need to slow down the strategic plan. We can handle both.
So that extra 60 days, it almost gives you kind of, my sister likes to call it a rubber elbow, to really make thoughtful choices without feeling like you're in a pinch and you're not worried and thinking about, we're going to launch this campaign on the 29th of the month and the credit card bill is due on the 30th. And now we're going to be paying all this interest. Just the breathing room, the pressure relief of being able to reallocate money, that you want to try new things and do new things, but you don't necessarily have those funds up front.
I'd welcome the extra breathing room. A 60-day term can really smooth out cash flow, lend me the time for my payables, reduce short-term working capital pressure. It make larger expenses less jarring. It gives me the flexibility for short-term investments, whether it's for repairs and without needing a line of credit.
As Bartaco being a growth brand, I think it really just allows us to plan for the expedited growth, right? Really, we have to keep a conservative outlook on that because, like you said, something unexpected happens every day. So it really allows me that safety net while kind of stretching ourselves on the growth side. I think, though, it would allow me, outside of like restaurant development, it would allow us to confidently take on some more projects in-house.
Right. So with additional cash flow, we would activate different marketing opportunities. We actually have a lot of radio and TV advertising we'd like to start activating. And one thing we find is they want those bills have to be paid initially, and you're waiting for the ROI. So there's getting an extra 60 days of cash flow to see the ROI on those advertising marketing levers that we've pulled, and then use that to actually fund those marketing campaigns. I think is a really kind of new, nuanced way of doing it, because right now you're either paying with the cash out of your bank or you're putting it on a card that in 30 days you are paying that bill. And with a lot of these projects we've been doing, we don't even have a finished product in 30 days. We're activating it, we're filming it, and then it's getting launched.
Use the funds for a long-term investment, staff training, tech and efficiency tools, debt management as well, being able to pay down some of the debt that have higher interest rate obligations strategically. I would say those would be some good key factors.
I think restaurant perhaps has a stigma around it of being a failing business, right? Like there's all those stats out there that a restaurant fails every day. So I think they're very risk averse when it comes to the restaurants, and they're trying to apply more commercial business models onto the restaurant industry model. And it doesn't work. If I don't pay my vendors, they stop deliveries, and I can't make food and cocktails and sell it to my guests. It's more of a tangible, more of an instant, more of a quick turning business. And they're just trying to apply these very archaic, rigid underwriting models to something they don't understand.
I think that traditional financing hasn't offered this type of 60-day terms to businesses, especially restaurants, is because they make a lot of money off of the interest after 30 days. They're making a lot of money off of the fact that people need funding to accomplish their goals, and people are willing to sign on the dotted line just to achieve that next marketing plan. And then 30 days from then, they're realizing, oh my gosh, I have all this interest I have to pay. And now your credit card terms you're using up that credit, you're increasing that credit by the interest being applied to it. And so I think they don't really find benefit to themselves.
I think with the banking and credit cards, they long operated in a 30-day billing cycle. They tied to the system, and the risk module extending this 60 days requires a re-engineering on their end, re-engineering in the assumptions of underwriting purposes. They're really collateral focused, right? In a traditional lender, they prefer loans backed by hard assets. In the restaurant industry, we're really brand recognized. We're customer base, which is really hard to collateralize. I think that's a huge thing for the banking institution, and also for variable and cash flow.
this is where you guys are like really nailing it. You guys understand how restaurants work. You understand when a restaurant is run well, the operators running the restaurants are running that thing 24/7. Right? Like that is the most dedicated, insane, maniacal business people that you'd ever want to work with. So why wouldn't you want to work with them?
So I think it's very clear that Tab not only is thoughtful about how they want to interact with their clients, but also takes into account what restaurateurs are saying about what they need. And then I also know that it was born out of people who understand and have worked in restaurants. So I think if you've lived a restaurant life in any way, you already are ahead of the game when it comes to how you provide solutions to restaurateurs, different than people who have been in finance their whole life and they've lived by cut and dry rules. Restaurants are not, you don't live by cut and dry rules. A lot of times it's finding creative solutions to very big problems. So I think it's evident in the way that Tab has helped us solve problems and solutions they provided that they're very much in tune with what restaurateurs need.
A traditional credit product is designed broadly for small businesses, but it's not really tailored to the unique cash flow cycles of restaurants. There's an innovation gap, and it's a gap that Tab is closing in on. Innovation is something traditional banks haven't embraced as quickly. Traditional finance hasn't offered 60-day terms to restaurants mainly because of risk perception. I think there is a traditional structure that they're key on, and banks stick to that. Whereas newer solutions such as Tab is finding ways to tailor around these realities of the restaurant operation.